Thank you very much, Ridhima. We have, like in all the previous sessions, we have a wonderful panel here. Ridhima has already introduced this stellar panel, so to say. And she said that we will discuss where to invest, equity, debt, and beyond. And my obvious question initially was, what is this beyond, And probably we should try to explore what is this beyond. Is there anything beyond equity or debt? We'll come to that later. This is also, this session is also, in my view, is symptomatic of a major transition of Indian society, Indian economy, Indian style of living, because this is probably the first major meeting that Business Standard is organizing in a physical format. And we had this COVID, which kept us indoors, online. And my obvious first question to all the panelists would be, how has the emergence from COVID-induced a kind of not a setback, but it was definitely something that must have halted all of you in your way of living, way of doing business. How did you look at equity during that time, debt, and if there's anything called beyond, what was that? So my first round of questions probably would be that how did the industry, you are the CEOs of the mutual fund industry. How did you perceive the impact of COVID on your businesses? And the corollary question would be that how do you see the business going forward as your economy emerges from COVID? I would start with, not because she's on my left, but because she's Lakshmi Iyer. So Lakshmi, why don't you start?
Sure. Hi, very good afternoon to each one of you. I was just telling Mr. Bhattacharya, we will figure out, because we had parallel sessions running at the same time. I was just trying to tell him that we do not know which audience will sleep more, because it's the post-lunch session, and anything on finance is not as exciting as what we see in our personal portfolios. So on that note, to your question, I would say there has been a marked change in mindset, in attitude, in behavior, in terms of how we have morphed ourselves very beautifully from, say, a Zoom barabar Zoom to a Zoom barabar Zoom. So that's been the, I just landed this morning from Oman. And मुझे literally लगा कि लंगर बट रहा है इतना जैसे फ्री में टिकट मिल रहे हो ऐसा लग रहा था because the flight was overbooked. And it's not just Oman, I would say, whether even if it's Delhi or Chennai or Bangalore, it's a similar kind of thing. So I think that's been the big change. The second change is I would say the mindset from the fact that nothing is impossible to everything is possible. I think that is the other big change that we have seen in the mindsets. From a global central bank perspective, I think we are morphing very well from a period of injection of steroids to a liposuction stage. So which is a quantitative easing morphing itself to a quantitative tightening. And I hope not that we have to see a similar kind of a scenario again, because that's a very scary situation to be in again. Hopefully, bulk of India is vaccinated. So I think that's been the gradual shift that we've seen in the business mindset, how you thought that virtual dunya hi sabhi hai. So from the real world, real, which is R-E-E-L to R-E-A-L, real world. I think that's been the change which we are all cherishing. From an investor mindset, I would say on two asset classes specifically, because crypto, I would rather not talk about it because it's...
Yeah, let's not talk about that.
Yeah, because that's more a 20 minus which can talk about it. I am 40 plus, so I'd rather not talk about crypto. But I think from an investor mindset standpoint, it was more like on the fixed income side, the question always was, kitna deti hai in terms of mileage? So what kind of returns are likely? And for equity investors, what do I say? You know, you are looking at the numbers and it's already discussed. The mindset was more like Shiva in Brahmastra, that mera aag se koi rishta hai, main aag se nahi jalta. So that's in a nutshell how I would describe this metamorphosis.
Okay, thank you. Thank you. As always, peppered with Hindi film songs and Hindi film, legends, so to say. Let me turn to Naren and get his point of view on how has the journey been from your industry point of view, and how do you see it going forward?
I think no one would have believed that, when COVID hit, the macro management of India in retrospect turned out to be better than the macro management done by the Western world. So the end result was that inflation in US, the numbers have come higher than CPI in India. That happened primarily because of the macro management done in the Western world, because people felt you can print any amount of money, do any amount of fiscal deficit, and inflation won't come. Mm-hmm. And that turned out to be a completely different experience 2 years later. And if you look at if COVID had come 10 years back or 20 years back, I think the post-COVID situation we would not have managed, because neither would we have had we had a very good telecom system and a very good internet and technology interface. So we could do COVID app, we could do a superb vaccination, put everything into COVID app and do it. So in 2020, if you had asked people felt that only China was unaffected and India only was affected. Look at the situation, what people talk about today. So I believe that, and in 2021, people felt that any loss-making company could be listed in India at any price to any set of investors. So finally, as we speak, what we realize is you have to be rational, you have to be logical, and policies also have to be logical and rational. And if you pursue illogical policies, the impact is later, like what US has realized today. And even as investment professionals, what we keep telling our teams is never be irrational, because in 2021, across the world, people invested in loss-making companies. And today, you know what has happened to all of them. And all these new age companies, people said there's no need for profits, all you needed was sales. Today, all those companies, all those investors are now suffering. So I believe that, what the last 2 to 3 years have shown is that you have to believe in technology, but you have to always be rational, you have to be sensible, you have to work things sensibly and continuously keep working hard and not lose sight and then start doing stupid things. And that is the lesson. And it's an endless marathon. So today, if any country pursues macroeconomic policies which are stupid, if as an investment professional I do stupid things, all those impact is not seen today, it is seen much later. And that is why it is imperative that when we are managing other people's money, we have to be always grounded and do the rational things. So at most of the times, what you do rationally today seems illogical today, but the benefit is seen years later. And that's why in 2020, when we used to tell people PSUs are attractive, people used to say, how can anyone make money in PSUs? But 2 years later, now suddenly everyone is asking us, should we not buy PSUs? And today those prices are very, very different from when we used to push them as great investment ideas. And monthly we were asked, how can you have so much percentage of PSU in a portfolio? But today people are asking, should you not add some more PSUs into the portfolio? Mm-hmm. So that's why I believe rationality changes, views change, And so today when we look at debt also, the situation is different. 2 years back, we never told people to look at debt. Today we tell people to look at debt. So continuously we have to be sensible, logical and rational. I call it SLR.
Just one quick supplementary and a quick answer from you. Has the response from the investing community undergone any change in a significant way in this period? And how do you see that?
I think post-COVID, people were sitting at home, they started to become traders. And the initial timing was fantastic because they picked a time when markets were very cheap. So the first 1.5 years, they made a lot of money. So they all thought that it's very easy to make money.
So they became very savvy initially.
They were savvy, very, very savvy initially.
Okay.
See, unfortunately, I'm a big believer in behavioral finance. So in terms of that belief, I believe that at all points of time, people will get consumed by the greed of fear. So in May 2020, we went out of the way to tell people, look at credit after a credit event, but no one was willing to look at it. In October 2020, we told people invest in value or PSUs. People said, no, we won't invest. We'll invest in quality at any price. And so I think, at the end of the day, greed and fear and behavioral finance is a problem everywhere in the world. And that is why people invested in so many negative yielding bonds. And everyone thought that yen will keep on depreciating. Suddenly, in the last 2 months, now yen has appreciated 10%. How can a current account surplus country like Japan have a currency which is always depreciating? But people believed in it. Now suddenly they got the shock of their life this week.
Okay.
So I think that's why I'm a believer that investors don't change. And that is the need for asset allocation because investors don't change, and that's why asset allocation can bring easy returns to people over a long period of time.
Okay. Rashmi, would you agree with that, or do you have a Hindi song to explain that kind of a...
The problem is investor mindset is heads I win, tails I win. वो फंडा है. That is number one. And number two is उनको क्या होता है in any asset class. Tolerance levels are very different. For example, in equities, जोर का झटका जोर से लगता है तो भी the tolerance is very high. They give a long rope and we are seeing that longevity is increasing. लेकिन fixed income में जब जोर का झटका धीरे से होता है तो भी the expectation is that this has to be Teflon coated, which is why accidents जब होते हैं they are not able to. So in the tech index, when you invest in 2000 and till 10 years you get a negative return, capital भी आपका वापस नहीं आता, people are okay to live with it. So I think that mindset has not really changed. And that is probably the reason why you're seeing the gush of flows into equities still very rock solid. If you look at the industry retail data, whether it's retail, etc. And if you see the converse is true or the reverse is true for fixed income, where if you look at the X of overnight category or liquid for that matter, the category flows are net negative. That's because jo jhatka hota hai na, wo variation, it depends, who is giving you that jhatka. So if Big B gives you a flop, you are willing to tolerate that because वो बोलते हैं कि यार ठीक है यार, form is temporary, class is permanent. लेकिन अगर new upcoming कोई सितारा आके एक flop दे देता है, the tolerance is very poor.
Okay, let me turn to Mahesh. What's your takeaway on what happened during COVID, both from the mutual funds point of view as well as from the investors' point of view?
Yeah. So I think I will not repeat what Naren has said, but I think if you look at it as an economy, India has actually emerged much stronger out of this COVID period, and that's the biggest accomplishment I see for India because, I think the reforms what we had done pre-COVID, right, be it in the banking and financial services sector, the real estate sector, the GST reforms, all that actually prepared us, in this period. And when things started to recover, and I must give credit to our policymakers, both the RBI as well as the finance ministry in terms of they didn't really try to, while they want to stimulate economy, but in a very measured way. And that's why our recovery has been slow and steady, but without creating any kind of bubbles. And I think the overall, I think we were very much digital ready. I think, again, the reform, the whole Jan Dhan and all these opening of bank accounts helped in this period so that the economy was not disrupted. And same for our mutual fund industry also. I think the movement, adoption of digital and moving online was very seamless. And actually that led to explosion in terms of the growth, especially for new investors. If you look at in the last 2 years since COVID, the number of new investors who have come into the industry is huge than what we have done. The demat accounts, what we added, is more than what we did, cumulatively till date. And that has actually helped the industry to grow. And as an economy, I would say, because of the disruptions what we saw during COVID, I think India is now emerging as a kind of another superpower, because people have realized the geopolitics, which are being there. India is only place which is neutral in that sense. And the China +1 policy, which was people were looking at, that only got accelerated after COVID. And that should benefit a lot of Indian companies going forward. And I think that would take India, economy, if you look at in this whole period now, India's growth is much stable, much more sure, and likely to be steady, even when next year we are looking at global economy getting into a recession. So that's, what India as an economy has really benefited out of the COVID. And I think with the whole digital ecosystem of India, India has got a large talent pool of IT professionals. I think that really flourished in this period, because we saw that a lot of companies globally wanted to move towards digital, and India could really supply with that manpower. And that, to large extent, benefited the economy. And adoption of digital in this period for many corporates, we've seen has been much faster. And that makes our country, much more future ready, and to really go on the next transformation, what we can see in the next decade or so.
Okay, I just wanted to check with you as a supplementary. Has the demographic dividend, so to say, has played to the strength of your industry, or has it been a problem in post-COVID or during COVID?
So I would say actually it's benefited because as I talked about, the number of investors, now who have come in, the number of increase in the mutual fund folios, what we have seen, a lot of young people, millennials are also now looking at, because they are more tech savvy, right? Mm-hmm. And digital platforms which have come in made it easier for them to really access some of these products. They might not be large investors, but they have come in early, which is good, because when you get these, catch them at the early phase, and they can be there in the long-term journey in terms of creating wealth. So, yeah, I would say that it has
helped.
Helped, yes.
Okay, Srinivasan, what's your take on the COVID and how the mutual fund industry has responded to it, and the investors?
Whatever these guys have said. But from a market perspective, two things are important, right? Mm-hmm. Earnings and valuations.
Yeah.
Earnings have been the best into COVID. So 2020 to 22 earnings have been rocking. Way better than what we saw between 2014 to 2020, in fact, right? Due to various reasons, which I will not get into. Valuations have also been on the up. Valuations are much higher than what they were. Obviously, partly due to the significant easing that we saw not only in India, but across the world. So rates were down. They've gone up, obviously, recently, but generally that led to an uptick in terms of price to earnings multiple.
Correct.
And I also presume that valuations have gone higher because you're kind of seeing a savings glut, especially in the kind of investor population that we cater to. Now, this investor population is specifically benefited from COVID. So people like you and me, right?
Yeah.
COVID has been, apart from the personal losses that we've seen, from a monetary perspective, COVID has been a huge beneficiary, because we got our salaries, most of us got our increments, we didn't spend at all, our spend went down significantly, and our net savings jumped, plus the asset pool that we had gave you a huge wealth effect. You're seeing all that in the form of revenge shopping and revenge travel right now. So I think I wouldn't have imagined this when you were kind of into COVID, or even when the concern on COVID started to decline. But it's been phenomenal.
Okay, so that's a positive you see.
It's been a huge positive, if you ask me, yeah.
Okay.
Not COVID.
And so now obviously, there's the outcome of that, as a result, the way the investors have. Yeah, that's right. Let me turn to Rajiv. What's your take on this issue?
So I think not just COVID, even before that, whenever there has been any problem, the investor mindset has been buy the dip, and the central bank response has been throw money at it, cut liquidity,
Okay.
or increase liquidity, cut interest rates. Starting from late 90s Y2K issue, pump liquidity, cut interest rates. Global financial crisis, same thing. COVID medical problems, whether it's a medical problem, financial problem, or a technology problem, it's been pumping in liquidity, which worked like clockwork in 2000 to 2021, 22, 2020 to 2021. The issue now is that they are facing consequences of that. So earlier it was something they could do without repercussions in terms of rising inflation or things like that. This time they don't have that option. Now they seem to be committed to providing real interest rates to savers and not cut interest rates at the slightest pretext. Given that, I think the situation today is that you have a whole set of people who haven't seen a sustained period of equity downturn. People on this panel are old enough to have seen 92 to 2003, 11-year period where indices went nowhere. Audience, a lot of people may have seen only upward trending markets, maybe maximum you have a 6-month or a 1-year drawdown and things are back to normal.
Yeah.
So from that perspective, I think my fear is that people are probably over heavy on equities. I don't probably share the optimism of Lakshmi. I hope she is right. But I don't think that people are here for the long haul. Even today, as we speak, net inflows into equities are lower than the monthly SIP inflows. So that means while SIP inflows are coming in, people are also redeeming. And this is just 1 year of flattish kind of markets overall. So in a slightly longer tenure, choppy or sideways markets, people may lose faith in equity. And I think people who don't have the risk appetite or the tenure should really look at their asset allocation.
So are you saying it because of the interest rate firming up, so therefore the equity, is that what you are saying?
The small point that I'm making is people have been accustomed to central banks bailing out markets. That may not hold true in the future. That is one. Second is people have been accustomed to dips being recovered very, very quickly and have not seen an extended period of a downward or a sideways market, which is something that concerns me a bit.
Okay. Lakshmi would like to respond to, it was a direct attack on you, you know?
No, there is no attack. We are all in for, wealth creation. I think there is no two ways that equities is. So I don't think there is a divergent thought.
Sure.
The only one thing we need to keep in mind is at a time where X of SIPs, the lump sum flows have tapered down. So if you see X of equity, X of SIP flows, the industry was actually negative. We should also appreciate that at that time, the AIF folios or additions are actually going up. So which means people are either diverting money from their some bit of pool into, say, listed equities, but in the AIF space, or maybe in the private equity, or a combination of either or. There is no cause-effect relationship, so you really can't, determine whether it is actually attributed to that. Gold is actually seeing a negative net sales again month on month for the last 2-3 months. So anecdotally, price elasticity of gold is very high. So on a rupee basis, gold has actually touched a lifetime high. So that is the reason probably you're seeing some bit of redemptions. Bulk of it is attributed, I agree, to the rupee depreciation. So I think what I was trying to communicate is that the tolerance, because the mindset is, and especially to be fair, in the last maybe 2.5 years, the retail investor has barely seen a negative return in equities. It is always like tic-tac-toe and there you go. So that Midas touch is kind of playing on the investor mind, so much so that even if you took anything in the CBM category, now I'm sure the audience doesn't know what is CBM category. This is just a colloquial thing which we discuss in our dealing room. CBM is basically Chor Bani More. So Chor Bani More category is dancing right now, and it's not even monsoon. So yes, it is time to be cautious. So I echo the concern that there is marked, I would say, high-ended optimism which the retailers have pumped into the market. Going forward in the next 12 months, is it going to be a bumpy ride? The answer is probably yes. It's not going to be a slam dunk that there is going to be money short on the table. And with the kind of, the medical crisis which is resurfacing, we don't know whether it is just like a green shoot effect or literal. One needs to be guarded. There is no two ways about it. But in general, it's been our experience and observation that you give a slightly longer rope to the asset class called equities, because equities always is shouting that रिश्ते में तो हम तुम्हारे बाप लगते हैं, नाम है equities. and fixed income is always shouting to the investor कि अभी ना जाओ छोड़कर कि दिल अभी भरा नहीं.
There's nothing to beat you on that. Naren, why is this, there is some wariness which is getting reflected on the equity side. As I think both Lakshmi and even Rajiv, Srinivasan, Mahesh pointed out, there is enthusiasm about equity, but there is a sense of concern. Would you share that concern, and why and how? And investors need to respond to that concern over investments in equity?
I think for about 2 to 3 years, I think there was no need for money in the debt market or deposit market. So if you look at the data today, the last 1 year, credit growth has been some 19 lakh crores.
Yes.
Deposit growth is only about 15 lakh crores. And government may have needed something like 5 lakh crores from the banking system for the government securities market. So the need for money was 24 lakh crores, and the deposits have grown by only 15 lakh crores. So I think after a long time, the need for money in the deposit market has come. And you would have seen multiple rate hikes on the part of banks in the deposit market also recently. So I think that is the main factor, because for a long period of time, banks were fund flush. The core liquidity in the economy was very high. I think that also has played a role. Rather than anything negative on equity, I would say that a lot of system participants are saying, give me money in deposits. Even from a market point of view, we have been telling people invest in debt mutual funds, because you go back 2 years back, an overnight fund would have given you 3%, and I'm taking overnight because that's the most certain, and which we can talk more easily about from a riskometer point of view. Today, the same overnight fund will give you 6%. And so you invest for 1 day, it gives you 6%. So that kind of a framework happens at this point of time, that even on an overnight return has gone up from 3% to 6% at this point of time. So I think debt is becoming a much more structural asset class at this point of time, because from 2008 to 2021, you had 2 printing presses in Washington and Brussels. Both those printing presses are closed. And this week, even the Tokyo printing press is threatening to close down.
Yeah.
So if all the printing presses are closed, then you have to depend on local savings for local needs of money. Because if all the printing presses in the world for printing money are closed, you have to depend on local. So I think due to that, debt becomes a structural asset class, and if debt becomes a structural asset class, we finally have competition for equity, because for 13 years you had no competition for equity because you had 3 printing presses. And that, I think, is more the reason rather than anything that has happened in equity market. So I would say it's more the attractiveness of debt as a structural asset class, because no one now believes that Fed is going to start printing money, which means that Washington is not going to print money. So that's why I believe is the situation.
Okay, but let me come to you, Mahesh. Would you agree? Is there anything more that is at play which has made the perspective on equity a little clouded?
So I think, hello. Yeah, I think the interest rates going up.
Yeah, we can hear you.
Okay. that has been one of the reasons, because if you look at last few years with low interest rates, everything moved into equity, right? We saw large inflows now, as Naren mentioned. Okay, now debt is an alternative which you can look at, right? Because the risk reward, if you look at in debt on a near-term basis, is looking fairly well balanced. So that now becomes an alternative for investors to look at. But I think other concern, I think, which is there is because a lot of narrative now talking about how the increase in interest rates is likely to impact the global economy, right? People are talking about US getting into recession. Europe is already into recession, right? With quarter-on-quarter GDP growth of negative. And to what extent that pain will be, I think that is still uncertain, because whether it will be only a couple of quarters and then it will bounce back, or it will be slightly longer period, and what impact it will have on the corporate earnings growth. I think that is an uncertain period which I think we are getting into. And I think that is weighing back on the minds. And not only here, but global investors also. And we've seen that markets have been a kind of in a corrective phase. We haven't seen that much of an impact because our growth, to some extent, has been more resilient, and we are not seeing any major downgrade. But I think that is an uncertain period we are getting into the next calendar year, which I think investors are slightly worried about, and the whole narrative about slowdown is slowly gaining momentum. Okay. So I think that probably is something which investors would be worried about, I guess, and that's why we've seen some smart money is moving out, right? So when we see, while SIP is continuing because SIP is more retail money coming in, but some smart, but it's more of a tactical movement. I still believe that this is a market, in the correction, what happens? I think structural story for India is very, very strong. So say that correction, whenever it happens because of these concerns, will be a good opportunity for somebody to buy into equity with a favorable risk reward, because at the current juncture, we believe that the risk reward is very well balanced, right? So one should also look at debt as a part of an allocation if you're putting in money for the next 1 or 2 years. Obviously, longer term equity still would be a great investment. So I think that shift is something which I think you would see in the coming quarters, asset class shift.
Srinivasan, what's your take on this equity versus debt right now? You know, I mean, the three gentlemen, the lady and the two gentlemen talked about how the equations is slightly different. You know?
So let me start with a disclaimer. 100% of my money is in equity. Even incremental savings go there.
Okay.
Having said that, our house view is negative equity. So
house view is?
Negative equity.
Negative equity.
Yeah, so on a 50-50 equity debt benchmark, our model says, which is a fundamental model, that you should be underweight 20% equity. And we're negative on equity because equity valuations are way too high. When you look at earnings, even adjusted for bond deals, for example, equity valuations are way too high. And the equity risk premium, basically the spread that you get on equity or expected return on equity is way lower compared to what you're getting today on sovereign debt. So on a short-term basis, say 1 to 3 years, you should be more into debt than equity. That's
okay. If I can ask you as a supplementary, why are you 20% negative on equity? What are the reasons that you have cited?
Okay, so we run a model, fundamental model, which is based on 3 pillars: earnings, valuation, and sentiment. Right. So on the earnings side, we are seeing the macro drivers are positive for earnings. Even on a micro level, earnings have been very buoyant, like I said, for the last couple of years. And we expect earnings growth to continue. So this year, I think we're expecting 12-13%, but we started off with 18%. So while I say earnings are positive, there are also downgrades on a quarterly basis. But earnings, broadly, the trend is positive. On valuations, we are somewhere closer to the 85th, 87th percentile. When you look at a forward P ratio, you look at a price to book, we look at something called a Schiller P bond deal spread. Basically, Schiller P accounts for earnings cyclicality, and you take out bond deals because P's typically go up when bond deals are lower, right? Now there is a headwind there because bond deals are going up. Okay. So there we are closer to the 85th or 87th percentile. You want to be lower than the 50th percentile. So our expected, I don't want to put an expected number. We kind of regress this to 3-year forward returns. But if I kind of put out a 3-year forward return, it kind of says that is the return that we expect. It is only indicative. So that spread that we get on that expected return compared to what you're getting on sovereign paper today is just not good enough from an equity risk premium perspective.
That's right. That's right. Rajiv, where are you on this debt versus equity? You have already shown your preferences, but why don't you elaborate on that? Why is equity. You are slightly low on equity. Yeah.
Yeah, I started on
Yeah.
this point, so
You-
let me
you did that, yeah.
diverge a bit now.
Yeah.
So we have all heard the story about a person who was 6 feet tall, drowning in the river, which was on an average 3 feet deep, right? Because
Okay.
averages hide a lot of things. At some places, it could be maybe 20 feet deep.
Yeah.
So I'll expand on the point that Naren made. He spoke about quality at any price kind of companies, and he spoke about loss-making companies.
Yeah.
In the last 20 odd years, I've seen individual quality companies, which were quality companies even 20 years back, which continue to be quality companies today. These in 2003 would trade at 10, 11, 12 times earnings. Today they are trading at 80, 90 and 100 times earnings. So what 2 decades of very, very low interest rates have done is, and Buffett has also spoken about this,
Yeah.
at one point in time, a bird in the hand was worth 2 in a bush. With 0 and negative interest rates, birds are at the same value whether it's coming 1 year from now or 20 years from now. So that has, I think, fundamentally changed now with the rising rate scenario. I think if not a price correction, we will see significant time correction in some of the
Significant?
time correction,
Time correction.
where stock prices go nowhere and earnings have to catch up. So I think that is a real possibility to me in the so-called quality bucket and the loss-making bucket. At the same time, I think there are pockets where one is seeing value on an absolute basis and even a relative basis compared to their own past histories. So just to name a sector, financials, for example, are coming with a very clean balance sheet now and are looking at credit growth and spreads and things like that. So I think averages will hide a lot of things. One has to go beyond the averages.
Okay. Are there any exogenous factors that you are not taking into account which can change this, your assessment of this?
I think exogenous will be this whole overweight equity thing that people are on. I think 1 year money, 2 year money should not be fundamentally in equity, which people will learn the hard way in the days to come.
Okay. Srinivasan, let me come to you because you are most categorical about equity not being your favored and
But I
preferred.
also said 100% of my money is there.
I know that. Yeah, I know that. A lot of people are expecting many things from the budget. Is there anything in the budget that you expecting or you think could change this thesis of yours? What could change the outlook on this front from the budget?
Nothing at all.
Nothing?
Yeah.
The basic fundamentals remain the same.
Yeah. I'm pretty bullish on the growth story of India.
Uh-huh.
But yeah, nothing that I expect that makes equity more positive.
Or less positive?
Yeah, I hope they don't increase capital gains.
So capital gains is something that worries you.
Yeah. I think logically they should. Maybe they would, but I don't know. I
You're
have
not
no
worried
insights.
about the borrowing levels, interest rates still continuing to go up.
See, I'm not an expert on macro here, so I think this question is
Okay.
better taken by others.
Okay.
But yeah, our view on interest rates, we of course have our house view, that interest rates may not go up significantly higher from where we are right now because we're seeing a pivot.
Okay.
And you've seen what RBI is also telling you.
Okay.
So we're not expecting interest rates to go up significantly. Is that a tail risk? For sure,
Okay.
but not what you expecting on a higher probability base.
I understand. Yeah. Is there anybody? I mean, three of you would like to comment on this budget changing the perception on the equity versus debt scenario? Yeah, please go ahead. I mean, whatever.
I don't see any material. Budgets really don't really make that big. We make a lot out of it. But finally, we see that whatever direction the government has set in the last budget, I think in terms of development, infrastructure, and that will continue. But we don't see any major impact in terms of, say, interest rates going up. I think at the end of the year, government tries to manage, right, your overall expenditure in terms of what they have planned. revenues have been fairly strong, okay, because of GST collections and others have actually surpassed. So there is room for the government to really manage some of the expenditure which has gone higher because of higher fuel oil prices, the fertilizer subsidy. So it's to be fairly well manageable. We know the government is going in a path for also tighter fiscal, faster fiscal consolidation. So I think growth would still be the prerogative because getting into the elections 2 years down the line, they would want to see the economy in a good shape. So I don't see anything majorly negative coming in the budget except probably from taxation perspective.
Okay. Naren, I mean, you are a behavior finance person. I mean, do you think something in the budget may happen or may not happen which affects the perspective on debt and equity?
We've seen 90s budget. At that point of time, tax rate started very high and moved downwards. So, we are still, the entire country, maybe media is still thinking of 90s. But unfortunately, there's no scope for taxes to go down like what happened in 90s. That every year we can hope that in the budget tax rates can go down. That scope doesn't exist. Obviously, I would say that there is, in the last 5 to 7 years, the amount of money which comes into equity has gone up. And see, if you look at the net amount of money that is available in debt has gone down, which is, I don't look at it on the basis of money which is collected by bank. The amount of money that is required by the government for fiscal and state government for fiscal, etc., that has gone down. So somewhere we need to incentivize financial savings in debt now.
Okay.
Over a period we have, so if that something happens there, like for example, if you reduce long-term period for debt, that will be useful because I think money will come into debt.
Okay. And that's one positive thing.
That would be a positive if you reduce that because finally at the end of the day, today, I mean, in this entire period, I have not seen in this audience the number of people who would have invested in debt mutual funds will be much lower than the number of people who have invested in equity mutual funds. So I would say that if you reduce the long-term period from 3 years to 2 years, I'm sure that the number of people will go up. So that's what we would like to see. Whether it will happen, not happen, that's not. But I don't think the government has some magic in a budget today that they can go and change. There is no magic budget like 90s. There is no customs duty of 40% which can be brought down to 10% or something like that.
350% brought down.
All that is not there. So let's accept that the government doesn't have it. Can we reduce long-term from debt from 3 years to 2 years? Yes, in debt. Yes, certainly that's possible. Can they do it? Yes. Will it have big impact on collections? No. So maybe they can consider that, that's all.
Okay. Lakshmi, your take on that? Budget being irrelevant? I mean, Naren has made a very fundamental point, and I entirely agree with you. It's by and large, it's overrated right now, to be honest. Yeah.
No, so certain contours are laid down in the budget more from a policy-making perspective, and it just so happens that budget happens to be the starting month or the period of Valentine's. So what I'm trying to say is that it doesn't have to change your love for the asset class.
Okay.
You can fall in love with the budget, but does it really change your outlook towards an asset class? Very, very unlikely. It has to be more the fundamentals. Yes, you can draw some cues in terms of certain categories. And to Naren's point, if you look at India's structure of asset class capital, I would say the taxation structure, fixed income is taxed at 3 years being long term, whereas equity is at one year long term. And the mindset of the investor to stay around for 3 years right now is only for the fear, yaar, mera tax katega. So that's the mindset. So yes, you can. There is a case to rationalize that. Will it happen in the B day, V day, after that day? I really don't know. But I think time has come that we try to rationalize and route some savings across from what is required to what is right from an investor standpoint. We have seen consistently that asset classes deliver returns in cycles and in patches, and it is agnostic of a monetary policy or agnostic of a budget. So fundamentally, if you have your asset allocation right, to Asan's point, he said he might be, or the house view might be negative on equities. But if you are looking at wealth creation, which is true for most of us sitting in this room, वो नींबू पानी पीने से तो वो नहीं होगा. You need some steroids, you need some caffeine, and that is going to come out of equities without a doubt. But near term, those glitches will be there. I was dune bashing in the deserts a couple of days back, and to do the terrain of the sands, you need to deflate the tires. So as expectations of returns in an asset class deflates, you are slightly more pragmatic towards making an investment decision. It cannot be the flavor of the season or flavor of the week. Aaj kaun sa chalega, aaj ka kya flavor hai? That's not going to work.
Yeah.
That mentality is good to make some quick bucks to be able to, fund your next date. But beyond that, I think it is the fundamentals which have to play. So it is B day or V day or MPC day. I don't think that should be your guiding principle.
Okay, wonderful, wonderful. Completely demystified budget, deglamorized budget. Let me turn to the final round before we take questions from the audience. Is there anything that needs to be, let me start with Lakshmi, anything that needs to be done on the regulation front? There is a lot of talk about how regulation has to be soft and yet vigilant. Your take on that?
So I think from a regulatory standpoint, enough is already under the works. We have already seen quite a bit of things getting streamlined. In the name of transparency, for example, it could put X-ray to shame, for example. So that's the kind of transparency that it provides to every stakeholder, whether it's a manufacturer, whether it is the investor, or whether it is the channel partner. So I think that transparency in itself is a great or a tall statement to boast about and take home. There are a lot of best practices which probably the rest of the world is trying to cut copy-paste from India in terms of how to really conduct itself. And equally important for us as regulation in India is to try to pick up some of the creative, I would say, product positioning. As a case in point, a lot can be done on that front, whether it's on the leverage side, whether it is on derivative side. We recently saw, AIFs being allowed to do credit default swaps. So I think these are some of the mutual give and take that regulatory authorities can do, say, between India and the rest of the world. We learn some and we take some.
Sure. Naren?
Clearly, I think we don't have a vibrant debt market. And I don't know why we have not managed to create it. We managed to create such a beautiful equity market, derivatives market. The depository system has also been fantastic. Why we have not managed to create it over a period of time is something for...
That what is you?
I mean, it should be as easy. Today, it's so easy to sell stock worth 25,000 rupees. But if you bought there's no way you can buy debt of 25,000 rupees and sell debt of 25,000 rupees other than through mutual funds. Of course, that's good for mutual funds. But otherwise, I would say that the fact that there's no easy debt market, I would say something has to be created so that it's very easy to do it the way BSE and NSE has managed to create a beautiful equity market. We need to create a market which is easy in debt as well.
Is the government responsible for it in the sense that government itself is such a big borrower that probably, the need for a vibrant debt market?
Why it has not happened, something which baffles me, because why this has not happened. Maybe I would say that the whole STT mechanism which got created in way back led to a very, very good nationwide market, and the exemptions given for tax based on STT was responsible for creating united market through stock exchanges. So maybe we need some very, very small STT and some tax concessions in trading debt so that people start trading debt.
Oh, that's an interesting thought actually. Mahesh, what are your thoughts? I mean, why hasn't we developed a vibrant debt market? And that actually is something that the doctor has ordered for the Indian economy for quite a few years, that you need to have larger avenues for financing, and if you have a proper debt market, you would. So why do you think it has not happened, and what needs to be done?
Yeah, I don't know. We have been trying. I've been talking about this for a long period of time. Okay, we have seen now that there have been index funds, okay, which have come in on the debt side, okay, which is in a way trying to get participation over there on the debt side, which we've seen regulation on that front coming in, and some of the funds have come in. So we've seen to some extent progress on that front, but otherwise, yeah, it's been a tall cry in terms of trying to, from the industry side, okay, to make it more, because how do you provide liquidity over there, right? So you need to have more liquidity in the debt market, only then only you will see retail participation come through. But yeah, I would say that we need to work closely. That's an area where regulation probably can do more on that front. I think equity is well penetrated. I think you need not sell equities now, right? It's automatic, right? On debt, I think we need to incentive either through some taxation, provide more liquidity, come with other products and instruments, okay, which will be easier for retail investors to participate.
No, sorry, I have no views on debt. I have no views on debt. I'm an equity CIO here.
I have plenty of views to make up for Srinivasan not answering. Probably this is not the forum, but quickly I'll make a few points. One thing is government itself competes with its own bonds.
That's what the point I was making.
You have RBI floating rate bonds, which have no interest rate risk in that sense.
Yeah.
You have the, now of course rates are comparable between traded government debt and the small savings rate, but otherwise small savings rates were 1.5% higher than traded bonds. So why would anyone buy those traded bonds where there's no tax incentive plus asset management fees will be there? So that's the other point. Third quick point is, I think you cannot have high grade corporate bond market, a liquid market, without having a highly liquid distressed debt market, which seems ironical, but people like Howard Marks and all have made their mark in distressed debt. Today, if someone defaults and the market is going to disappear, then there will be no market below the AAA market.
That's right.
And to Naren's point of why is it not easy to buy and sell small quantities of treasury bills, I think in equities they made one single change which solved this problem. They removed the concept of a minimum lot. So you can buy and sell one share on the
They have not done it.
on the platform in debt market. You can put minimum fill 5 crores or minimum fill 25 crores. Obviously, you don't have liquidity. If you convert that to equity, I think the treasury bill and government bond market on NDS for liquidity papers at least, it's quite active.
Essentially, without your specifically saying it, that the government needs to mend its ways as far as borrowing is concerned. Fiscal deficit must come down, which probably...
So we are confused between wanting a liquid market versus protecting the interest of
The government.
savers, senior citizens, whoever. And I'm not saying one way or the other, but we can have only one and not both.
Sure, absolutely. I think let's get some questions in. Yes, please go ahead.
Hello.
Yeah.
Good afternoon, gentlemen. Hi, ma'am. So, sir, like Srinivasan sir spoke, like he's really bullish on equity. So, I do resonate with the idea that mutual funds sahi hai, and to everybody else here, mutual funds are subjected to market risk. Please read all the scheme-related documents carefully. So, the question here being, so I do understand that there are certain risks associated with it, and now why I'm asking you this particular question is, so I read this recent, regulation that came out from SEBI where it says that asset managers must have at least 20% of their assets allocated to, in the game. They should have their skin in the game. And now the question here is, so when they have their skin in the game, what is the outcome of it? Because I see two sides to this. It is either that now that they have their own stakes in the game, they work harder and they try to bring, a more standardized...
Can you come to your question, please?
Yeah.
Your question, please.
Yeah, that's my question.
Yeah.
So I do understand, since now they have their skin in the game, they could either do two things. One is either, now that they have their skin in the game, they try to standardize the CAGR, bring out better results. Or now that they have their skin in the game, they try to go all out and make rash decisions, and the end retail investor might not get good results. So how do you think it would basically pan out?
Yeah. Who can take this question?
I can have a go.
Yeah, sure.
If a substantial portion of your net worth is in the scheme, there's no reason to be reckless. In fact, it disincentivizes excess risk taking. Our behavior has been the same before and after the circular, as I would think most professionals would behave the same way, whether that circular is there or not. I don't think it changes things too meaningfully.
I think it's a little unfair to the dead guys. I'm equity. My money was always in equity in my funds. But the dead guys who manage overnight, if they have to put their money in overnight because they have to show skin in the game, I think it's outright stupid.
Yeah.
So this regulation, there's a lot to say about this regulation, but I won't.
Yeah, we have 3-year lock-in on our liquid fund investments. So there you go.
That's the bail. There is a boon and a bail.
So, sorry, coming in on that, I mean, you take your mic. Yeah.
Sorry.
You said something very interesting. Yeah, go ahead.
No, I just said, see, what is skin in the game? The concept is simple. So when people invest, right, it is actually pretty common in private equity, where the key personal is it's an aspect when you analyze, when you want to put money in a fund, you kind of ensure that the key personal stay. If they leave, you have an option to quit. And you also want to check how much money do they have in their own fund, right? It is kind of, in our context, it is a little, I don't think the regulation is fair across all market participants.
Sure. Okay. Yeah. You wanted to add to it? No. Yeah.
No, I just, it's just that, if you are investing a good chunk of your money and, 50% of the industry or 40% of the industry is liquid fund, which has an AUM of 5 lakh crore, and you're investing at 6.5, and imagine you're a leveraged investor and the mortgage rates just crossed 8%, then you are running a negative carry on your personal portfolio. That's the only small chink in the armor. Baki sab badhiya hai.
Okay, good. Next, who?
For equity guys who are well paid, it's fine. For all others, it's a little.
Okay. Who is? Yeah.
Sir.
Yeah, they are first.
Yes, sir.
Yeah, go ahead.
I'm Hemant Joshi. Yeah. I'm in the equity industry. 1st February 1988. Lots of things I have seen. India is growing, but today we have only not more than 10 crore limit account. Your take, please.
10 crore demat accounts.
आप लेंगे ये सवाल?
No, but actually, if you look at the addressable market for many things in India, they're all stuck. If you look at the number of two-wheelers in India, it's stuck. I think if you read R.C. Bhargava's interview in car industry, it is stuck. You look at many things, everything is stuck. Not more than 10 crore. 10 crore is a decent number. I don't think we have 10 crore in many things.
Yeah.
That is the reality of India. That 10 crore is not a bad number.
Is a hell of a lot.
And look at the compounding that's happening in that phase, right? The more you're realizing, you had Demon as the first case, then you had COVID as the next phase. So there are multiple catalysts which are accentuating that process. So, the addressable population itself is not that 1.3 or 1.4 billion that you're talking about. That needs to be excluded. And then if you look at the number, and the stock was low. So as and when the base grows, if you start compounding at this base, that is the true metal. And with the demographic population realizing that this is the true steroid wealth creation. See, nobody is retiring at 60, or most of them are not retiring at 60 now. With the stress levels and the kind of thing, the new age is probably 50 or sub 50. So I think for that, the accentuation of wealth creation has to happen, and there is no two ways. That's getting realized, and that's reflecting in the demat accounts.
Think in terms of households. So population divided by, say, 4 or 5, and then there is the below poverty line or close to poverty line, and then this number is actually pretty good.
My supplementary question is, where other Indian cities are investing the money? Equity is a wealth creation, but people are not investing. What is the take for the industry? What industry should take care for the?
I totally agree, and I think we've been speaking internally about some kind of a broader plan where I think we don't have time right now.
No,
but I'm saying
we can discuss it offline.
to improve
Thank you very much.
penetration.
Thank you very much.
across
Thank
the
Thank you.
lower-
One last question from anybody? Hello. Yeah, please go ahead. Where is your mic? Mic, please. Yeah.
Hello.
Yeah.
Hello.
Identify yourself and.
Hello. I am.
Yeah.
Extreme left.
Yeah. Right. Oh. Okay. Okay, go ahead. You go ahead then. And then after that, you. Okay? Yeah.
Hello, myself, Keval. My question to everybody: since there is a report call from World Bank that there is a recession in US.
You get your mic closer to your mouth.
There is a report called US is facing a recession. At one side, gold prices are shooting high. There is a report called there is a increase in the interest rate. Even there is a report called there is a financial crisis facing in the US and UK market. So will it have an impact on the Indian equity investors in the coming years and view of earning and the valuations, its prospect of earning and valuations?
Mahesh, would you like to just answer it? Yeah.
No, so then, see, we have seen up till now, there has been some amount of decoupling which has been there. Okay, what's happening in the, if you look at year till date, our markets are up by around 7%. Okay, I mean this calendar year. I mean, other market, including US, will be down around 15 to around 25%, 30% also. But I think beyond the point, I think if global economy goes into recession, okay, there is, if that is deep enough and you see some kind of a credit crisis, I think financial markets in the end are all interlinked. So you will see the impact on that. And India has done well. Relative valuations are much higher. So if I think from here on, I think we can't believe that India will continue to decouple from what's happening globally. I think you could see an impact, and that's why I think next year could be slightly more volatile. You could see some correction depending on how the global risk plays out. And there are possibilities of that. So one should be a bit cautious, and if I'm getting into next calendar year, that's one of the risks which investors should really bear in mind. They should be willing to take some hit, some drawdowns in their portfolios. Though, I mean, the long-term outlook for India is all good, we all know about that, so that should be good, but short-term volatility would be there because of these factors.
Okay, last question.
Hi, I am Arun. So we talked a lot about equity and debt. So my question is around, I mean, what about AIF or REIT or InvIT space? I mean, we are not getting a lot of traction there. In fact, AIF is giving more than 15% return. So is it like we are still not convinced with AI space, or I don't know? I mean, we as a mutual fund industry, you guys are focusing more upon equity or debt.
Okay, fundamental question.
AIF invests in equity or debt,
Yeah,
so
AIF
that's
is
not.
more, yeah.
As far as REIT and InvIT is concerned, as and when more REIT and InvITs are issued, I think the industry will invest in it. So I think over the next few years, more REITs and InvITs will get issued, and the mutual fund industry will invest in it. AIFs themselves are not an asset class. AIFs themselves can invest in equity, long short. For example, we have a long short AIF. So there are different AIFs. AIFs themselves are not an asset class. AIFs can invest in equity, they can invest in debt, they can invest in distressed debt, they can invest in long short. There can be different asset classes, and mutual funds are not allowed to do that. They have to do it separately. They can't. Mutual funds are supposed to focus on only regulated asset classes.
That's right. Lakshmi, you want to add something?
No, so just that there are various mediums of gaining access to an asset class. It's a vehicle, it's a vahan. So mutual fund is one such vehicle, AIF is one such vehicle. If you want to do a credit fund, for example, you have a vehicle to do it through the credit risk category also in mutual funds, and you have private credit, distressed credit, performing credit, all of that in the AIF space. So yes, this category is mushrooming and it is here to stay. Risk appetite is visibly different. One is for a 5,000 rupee investor. Of course, even a 50 crore investor can invest. And the latter, or the AIF, is the threshold is 1 crore and above. And in some cases, the threshold is looking to increase. So both are very legit vehicles. Know your risk factors before you make investments into any of these through the vehicle for participation.
No Hindi song to end it? No.
Hindi, after listening to this audience, Hindi bol raha hai, ab thoda English bol
English.
raha,
Okay,
साहब.
okay, fine, done. Okay, fine. Now, I think we have come to the end of this wonderful session. I thought we learnt a lot, and with such a stellar panel, experts in both equity and debt, we discussed the impact of COVID and how the industry faced it. We discussed the many investment challenges, regulation, budget not being that relevant in a very marginal way, perhaps, need for education, awareness. We also realized that debt and equity, the house was almost divided. in the sense that debt had a certain flavor to it, but equity was looking like little risk, and it is always it should be. One final thought, equity, debt and beyond, that was the question that we raised. Is there anything beyond?
Basically, people forgot that you can have gold, silver, all these things. That's why we've been talking on multi-asset everywhere.
Yeah.
Because frankly, in a year where we think that Fed is going to stop hiking, an asset class like gold, silver may also perform. And this was a call we thought 3 months back. So I think that's why we thought of multi-asset as a framework.
Excellent. I think that's the thought which will end this. That probably the future is also about multi-assets. With these words, I think we'll call it wraps. And thank you very much, and give them a big hand, please. Thank you. Thank you.